All right, welcome here to week 12 in April, the week of April 6th. We have session 12, capital gains, which is chapter 7 of the text. I've got Blackboard pulled up. I'm going to scroll down to get a look at here everything that's due this week. Going back to chapter 6 with the small business, Schedule C, doing the shoebox returns for the masters. And then in chapter 7, it continues with the masters. I have some notes, some tax return help notes to get you started with some of the new stuff like depreciation and how to handle that. If you go into the assignment and assessments folder, as I'll do in just a second, and then the regular tax returns for chapter 6 and chapter 7 where you answer the multiple choice questions or fill in the blank. When we go into the assignments and assessments here, open up this tax return help, and hopefully that'll give you some good pointers on some of the new things with these tax returns. Okay, let's get right into our chapter today with capital gains. I'm going to switch this over. All right, here we go. Looking at the difference, one of the main things here is between what tax law calls Section 1231 assets. They're called that because they have a little different rules, and that's where the code is in the law. You go to Code Section 1231, that's where they'll talk about that. That's why if you ever hear of like a 401k, a 401k means tax code section 401, and then subsection K, and they talk about retirement plans. Capital assets, first thing to know about this. These are generally your stocks and personal use assets, and the key here is they are used over 1 year. Once you have something considered a capital asset, they have a little bit better gain treatment. So if you would sell your asset like stock for a gain, say you bought it for $5,000, you sold it for $9,000, you have a $4,000 difference there. That's what you're going to be taxed on, not the $9,000 that you sold it for, because you paid in $5,000, so you get to take out that difference. You're going to be taxed at $4,000. Now, if you held it over a year, that's stock, then you get what's called capital gain treatment, and it's a lower tax rate than if you bought and sold within a year. So I'll give you some examples of what I mean by capital assets. Again, I told you the long-term capital assets get a special gain treatment, and I explain here what I mean by that. If you're in the lowest tax bracket, any gains you have are taxed at 0%, which is obviously no tax. So it's like you got the gain free. And I give you an example here too of where your income would be to still be included in that 15% bracket if you're married, filing joint, or single. And you could look up the rest of those if you're head of household in the front of the book, the very front cover. And then anybody in the 25% and up bracket, they pay a capital gain tax of only 15% on their capital gains. And then it does go up though for anybody making over $250,000. That's beyond the scope of this class though. So that's if you have a gain. If you have a loss, losses are not so favorable with capital gains, as you'll see. The overriding rule is you're only allowed $3,000 per year of a loss. So if you had stock that you owned and you bought it for $10,000 and you sold it for $4,000, you had a pretty big loss, $6,000. You wouldn't be able to include all that loss on your tax return. What the loss would do is reduce your overall income. So if you had, say, a $40,000 a year job, and if you were able to take it all, then you would only be taxed on $34,000, the $6,000 minus the $40,000. However, that's not the case. Tax law says you're only allowed to take $3,000 per year away from your regular income. Now, the only other exception to that is if you have other gains with other stocks, you can net them. And you could, if you had a $5,000 loss on one and a $3,000 gain on the other, you would net all of it and then just have a $2,000 loss overall. And we're going to look at a couple of examples like that to help show you some actual numbers that I'll put up instead of just making them up off the top of my head. So you're limited to 3,000. Now, again, this is primarily the other bad thing about this. So one bad thing is you only get 3,000 per year. The other bad thing is this doesn't include personal use assets. So anything that you use like a boat or your car, anything along those lines, if you bought it for 15,000, sold it for 3,000, you don't get to take that loss. That is specifically excluded. Nowhere would you be able to claim that. The only exception to that rule is, remember back to itemized deductions, if there was a casualty or a theft on a personal use asset, then you could potentially take the damages. And remember all those different rules, though. $100 right off the bat gets taken away, and then the damages need to be over 10% of your AGI, which is pretty high, a pretty high threshold to meet. So losses are not allowed, but the bad thing is if you have a gain on any of those long-term assets, even personal use, like your car or boat, say it happened to go up in value, it was an antique potentially, those are taxed at capital gain rates. So that's kind of the bad side. You are going to be taxed on any gains you have. And if you had it over a year, then you get the capital gain treatment. So the short-term assets, things you have less than a year, nothing special, they are treated just like regular income. So if you're in the 15% bracket, you're going to be taxed at 15% like if you made money at your job. Losses on stock, you still have that $3,000 limit. So it doesn't matter on losses if it's long-term or short-term. They both are limited to $3,000. Again, that's only for stock-type items, investment-type items. Now, with netting rules, combining things, tax law does have a certain way that they want you to do this. First off, they want you to net, doesn't matter, all long-term gains and losses. So anything that's long-term, you get one final number. Anything that's short-term, do the same. And then possibly net the rest of it or not, depending on which situation out of the four that you could possibly have when you've netted your long-term and short-term. So if they're both gains, you got to keep them separate because short-terms are taxed differently than long-term. If you have one to gain and one to loss, either way, doesn't matter if it's a short-term gain or loss or long-term gain or loss. If you have one of both, you can go ahead and net them for one final total. And then losses, just like with the gains, keep them separate. So if you have both of them that are the same, gain, keep them separate. Loss, keep them separate. And in the questions at the end of the chapter in the multiple choice, one of the questions asks you, it doesn't even want you to net them. It says something in the last sentence, what is the pre-net final outcome for this taxpayer? And so make sure you read that carefully on that specific question. One of them will read, what is the pre-net? And they don't want you to do this final step. They want you just to do possibly step one, but it'll tell you there, but it's very hard not to go ahead and net them. You have to think, oh, that's not even what they want me to do. One of the important things about this chapter and the next chapter we do next week, chapter 12, is knowing the difference, and that's why I have this in a box. Anything I have in a box, I think is the most important. Knowing the difference between a realized and a recognized gain or loss. Realized is simply what actually happened, and we're not doing anything on the tax books yet with it. It's just saying, if I had, for example, a capital loss, if I had a $10,000 stock that I bought and I sold it for $4,000, I would have a realized loss of $6,000. Actually, what happened? Recognized, on the other hand, is even though it happened, what do I officially put on my tax return for recognition purposes? And even though I had in my example a realized loss of 6, I can only recognize 3,000. If you remember back to the rules, up a page up. 3,000 loss per year. So I can have a realized loss different than a recognized loss, and it could be quite common. And some of the things that just to keep in the back of your mind as you're doing the homework or anything, recognized gains, they can never be above realized gains. If you have a realized gain of 6,000, it'd be impossible to have a recognized gain of 7,000. Now with losses, it can be different, but with gains, it can't. Recognized gains can be less than realized gains, and we'll see that. So they can never be above. Gains can never be above. Recognized gains cannot be above realized, but the gains could be definitely lower, and that will depend on different tax situations. Recognized gains can definitely be 0. You could have a realized gain of 3,000, but recognized for tax purposes of just 0. Definitely could happen. And you'll never have anything flipped. You won't have a realized gain and then a recognized loss. That won't happen. So just a couple things as you're answering questions to go back and see if your answer happens to fit one of these to make sure it makes sense. All right, so let's look at a couple examples. Sell a personal car in 2000 for $10,000. No, excuse me. We purchased a personal car in the year 2000 for $10,000. We turn around and sell it 12 years later for $2,000. All right, so the tax treatment here, and we can answer these questions here. What is the realized and recognized loss? Well, the realized loss is $8,000. What I bought it for less what I sold it for. There's an $8,000 difference. And it would be long term because of 12 years, anything over a year. However, for tax purposes, the realized loss is 8. Recognized loss, what goes on the tax return, would be 0. Let me pull up my answers. So, personal use property losses are not deductible. I'll add a few other little tidbits in here. This would be a realized gain or realized loss of 8,000. That would be long term. However, recognized loss would be 0. Can't take any of it due to tax rules. Okay, so we go down to B here. Purchase a lawnmower on eBay for $200, sell it 2 years later for $700. Now, if this would actually ever get reported, probably not. But I'm just kind of going through here what the tax rule actually says should happen. What is the tax treatment, assuming if the taxpayer is in the 15% bracket? Remember back to our rules here. Right here, if you're in the 10 to 15% bracket, your taxable gain is at 0%. And B, if you're in the 33% bracket, what's going to happen? So in B, you have a realized and recognized gain. It's still recognized, and you still put it on your return. However, when you start to calculate your tax down on the back side of the 1040, about line 44, you're going to take that $500 back out when you're figuring your tax and do it separately. And we might see this when we look at a Schedule D in a little bit more detail in just a few minutes. So it's realized and recognized gain of $500. We're going to put it on the tax return, but not taxed. In Part B, when the income is higher, they have a higher marginal rate, then they are going to be taxed at 15%, even though they're in the higher tax bracket. Capital gains, you stop it at 15%. So when 15% based on $500, $75 would be added to their tax bill. And that's what I was meaning there. C, sold some stock for $15,000 and Walmart stock for $15,000. So we brought in $30,000. The Dell stock was bought a long time ago, and we would have had a gain of $5,000. The Walmart stock was purchased right at a year ago, and the rule is anything over a year is long-term, anything right at a year and less is considered short-term. So this would be considered short-term, and we also had a gain. So a $5,000 gain and a $3,000 gain. Taxpayer is in the 25% bracket. And then we go back to our netting rules here. They were both gains, so we keep them separate. We're going to tax the Walmart stock at the regular rate, and then we're going to tax the Dell stock at that lower rate, the gain at the 15%, because remember they were in the higher income brackets, so they do get taxed on their capital gains, but just not as much for their long-term capital gains. The short-term gains, they're simply taxed at whatever our normal rate would be. Okay, so the exact same thing except Walmart. We purchased it not for $12,000. Yeah, not for $12,000, but for $25,000. So we bought it for $25,000, sold it for $15,000. So we will have a loss of $10,000. Go back up to my netting rules. We had a short-term loss on the Walmart stock and a long-term gain on the Dell. So we can net them. So in the Walmart stock we had a loss of 10. The Dell stock we had a gain of 5. Net them, we have a short-term loss of 5. However, we can only use $3,000 this year, what is actually recognized. This would be the realized, the $5,000. Recognized would be the 3. And then knowing that anything that we can't use this year, we can carry forward each year and only use $3,000 unless we have a gain to offset that loss. Then that could definitely be just like how we had a gain to offset our Walmart loss. You can net those. It's just if you have a loss left over at the end, you can only take $3,000 of that. Now I wanted to look at Schedule D and how we would fill out how this would actually look on a real tax return. And you can pull up any of the Schedule Ds, doesn't really matter. I put on there Appendix E17, but there's some in the chapter as well. Let's just get a real quick look at how Schedule D is laid out. So at the top there, capital gains and losses. Where we would put the Walmart stock. Yes. Okay, so we have the short-term loss that we would put here for Walmart. Proceeds, we would say we got in $15,000. The cost being, and if we use the second example, $25,000. So therefore we had a loss there in line 1 of H of $10,000. and then we would skip down, because that's where we would put our totals. We would list each item, as you'll see in the tax return. When you're doing that, you'll list each item separately, and then everything will get netted there to line 1A. We haven't talked about anything on line 4 yet. We will next week when we talk about Form 8824. We'll skip that for now. We don't in this class, we don't discuss anything there with Schedule K1s or escorts. On line 6, we definitely will have an example where we have a carryover, and that carryover would be the example that we just did, where I said we had a $2,000, or the rest is carry forward, so it would be $2,000. I had a $5,000 loss and a $3,000 that I'm allowed, and then the rest of it's carry forward. That's where that would go. That's where next year that $2,000 would end up there on line 6 as a carry forward from the prior year. Now, in the current year, we didn't have any carry forward, so we would have that blank. But next year, we would have $2,000 there to start us off. The long terms, we would put the Dell. We bought it for 15. We sold it for 15, bought it for 10, so we had a $5,000 gain. Then it says, do you have any long-term loss carryovers? And we didn't so far, down there on line 15. Now it says combine line 7 and 15, and then this is where it wants you to start separating when you get to line 16 down to 22, and you can fill out the rest of that. But I just kind of wanted to show you there what the front part of Schedule D looks like. Okay, switch gears just a little bit. We're going to talk about gifts and inheritances, and then turning around and selling them later for a possible gain or loss. Inheritances for tax purposes have a really good deal in that whenever you sell something that you got inherited from an ancestor of yours that's passed away, it's considered long-term even if it isn't long-term. So, for example, somebody died in your family and they just bought stock not 2 months ago. And they died, you inherited it, and then 2 months later you turned around and sold it. That would be considered a long-term capital item. So if there was a gain, you would get that better treatment, even though you only had it for 2 months, and total, you and your family member only had it 4 months. It doesn't matter. In the case of an inheritance, it's considered long-term no matter what. The other good thing about an inheritance is the basis reflects whatever it is at the time of death, the fair market value. And that's the good part in that if the basis goes up, you get a much better gain treatment. So, for example, if somebody, an ancestor of yours bought in the 1950s some stock, very cheap back then, for $10 a share, and now that stock is selling for $100 a share. If their ancestor would have sold it right before they died, they would have had to pay a tax on their gain of $90. But if you get it as an inheritance, your basis is not 10 anymore like theirs. Your basis goes up to $100. And then if you turn around and sell it for $100, you have no gain, and that's a great deal. You don't have to pay any tax on that $100 that you got. With gifts, it's not such so straightforward for one, and it's not as lucrative as the inheritance part, where you get the stepped-up basis. It's not nearly as good. So, a couple things that could happen when you have a gift. If the first possibility being the donor's basis is less than what it's worth right now, so the stock has went up in value. And here's my little, just to help give us a little bit of a visual. The person who's giving you the item bought it for $10,000, it's now worth 12 at the date that they're giving it to you, you, the donee, must use the $10,000 that they bought it for. So you would have to pry a little bit and say, okay, if I would ever sell this, I'm going to have to use your original purchase price, not what it's worth right now. And so you would have to use the original basis of $10,000. So if you turn around and sold it for 12, you're going to pay the $2,000 gain, just like if the original owner sold it for 12. They would have had to pay $2,000. Thus, the government doesn't want to lose their tax. Up here, they were okay with it due to the death. But here, if you're trying to avoid a tax just by giving a gift, that's not going to work. You're going to have to die first before you can have your friend avoid a tax. Then the other situation where the donor basis is actually the value of the item went down. So their basis is higher than the fair market value date that you get it. In this case, well, your basis doesn't really come into play until you turn and sell it. And then there's three situations. Did you turn around and sell it for less than what it's worth even now, so it's gone down and it's keep going down? If that's the case, that's part B here. If that's the case, you sold it for 6, you got it at 7, you can use $7,000 as your basis, the fair market value. And that's not as good, but that's what you have to use. Therefore, you only have a $1,000 loss. You don't get to use the 10. So that $3,000 loss in the middle from what the donor originally paid, it's lost. It's gone. That's bad. The other situation is they give it to you, and then all at $7,000, that's what it's worth, and then all of a sudden there's a big turnaround, and stock goes way up, and you turn around and you sell it for 12. If that's the case, then the tax law gives you a break and says, you don't have to use the 7. We'll allow you to use the 10, your old donor's basis, and therefore you only have a gain of $2,000 instead of 5. The other way to look at it is to say, you can always use $7,000 as your basis no matter what's going on, and then you have a $5,000 gain, but then you get to deduct the part that's in between here the donor would have lost out on. The donor has $3,000 that they're losing in potential losses if they would have sold it. So you could take that $3,000 off of your 5 and get back to the 2. I like to look at it just as if you sell it for more than what the donor paid, you get to use the donor's basis. So only $2,000 gain. The only other option then, instead of selling it below or more than, is right in between. And if it's right in between, say at $9,000, then it's a wash. You don't have any gain or loss. That $1,000, if you sold it for 9, that $1,000 less than with the donor, it's not. Nobody gets to use it, so it's lost. And I have a note here: the donor, whenever the donor gives you something, like in the case here, the donor does not get to record a loss. Even though they had a loss, if they would have sold it in the fair market for $7,000, they would have had a $3,000 loss. That would have been the best option for them. If you have a loss, go ahead and sell it for 7, give the money whoever you were going to give it to, and buy a new stock at a $7,000 basis. Therefore, the donor gets to record that $3,000 loss, and the receiver still gets the stock. They just get it at $7,000, and then whatever happens from that point, the new owner will take care of it using that $7,000 basis. So I have some examples here. If we purchase stock in 1965, $500, the owner dies, and they update this Okay, the owner dies in the year 2014, since that's the tax year we're talking about. Its value is $40,000. The stock now, we bought it for $5,000. The heirs turn around and sell it for $3,000 or for $43,000 in a couple more months. How is this treated? Well, one, we get the stepped up basis. That's the great news. So our basis is $40,000 instead of what the original owner was at $500. And then when we sell it at $43,000, we only have a $3,000 gain. And note that it's long term, because anything that's an inheritance is automatically long term, even though we only owned it ourselves for 6 months. And if we're in the 15% bracket, that $3,000 is not even taxed, because we get capital gain rates for being long term, and anybody in the 10 to 15% bracket doesn't pay tax. So the long-term capital gain is realized and recognized, but when you actually go and start figuring the tax, none of that $3,000 recognized gain will be subject to tax. Okay, now we talk about a gift situation. Father bought it many years ago for $10,000, gifted it to his daughter, and the value now is $15,000, so it has gone up. So that would be our first example, going back up to the gifts. The donor's basis is less than the current value. So remember our rule, the donee will always use the original basis in this case. So the daughter's basis is going to be 10, no matter what it's worth right now, because the value went up. The daughter turns around a few months later and sells it for 18. She's in the 15% bracket. What is the gift basis, holding period, and any tax treatment? All right, for gift purposes, you get to use, even though you only had it for a few months, you get to use what the original person, you are assumed to have bought it in 1995. I can't remember if I put this on here. Yeah, here. And the holding period will stay the same as the donor in this type of situation. So we'll have a long-term item. Gift basis is $10,000. We sold it for 18, so therefore we have a realized gain of 18,000, and it's also recognized, all of it. No special tax treatment, except, even though it's all recognized, we're not going to pay any tax on it because the daughter is in the 15% bracket. So we do have to record the 8,000 as income, as capital gain income. So therefore it's realized and recognized. However, taxed at 0 when you actually start filling tax. Okay, one other example, just going the other way. Dad still has the same item, 1995. However, the value of the stock has dropped. The daughter's in a higher tax bracket. Let's go through the same steps. What if the daughter sold stock just like the prior time for 18,000 based on this example? So that it definitely went down, then it had a big upturn, and she sold it for a nice little profit. So remember, if the stock goes down, depends on what this sell price is. Since the sell price is higher, she's going to use the dad's old basis and his old holding period. So this will be a long-term gain of $8,000. $8,000, and she's going to be taxed at 15% because of her rate. So it's a realized recognized gain of $8,000. However, of that $8,000, it's not taxed at 33%. It's only going to be taxed at 15% due to that it's a long-term capital gain. Part B, she sells it for even less. It keeps dropping and dropping in value. She only sells it for $1,000. Her basis, in effect, is really $5,000. So therefore, she has a loss of $4,000. And it's short term because she's using this as her basis, so therefore she's using that date as well. But when it comes to losses, it doesn't really matter if it's short term or long term. They're treated the same. So it wouldn't really matter for tax purposes if it was short or long. Technically it is short. Of that $4,000, she has a $4,000 realized loss, but recognized is only $3,000. So I'll put that in here. Realized short-term loss of $4,000, recognized meaning you're able to actually take $3,000 of it this year. All right, selling your own home. Not a whole lot of stuff to talk about here. The biggest part is the tax law gives you a big break when you're selling your own home. As long as you've had it for at least 2 years, so you're not trying to cheat the system, it's actually your home and you've been in it for a good period of time. If you're single, you can exclude and not even put on the tax return at all $250,000 of potential gain. I don't know how they ever came up with that high of a number. That was definitely in favor of the rich. And you can exclude up to $500,000 if you're married, filing joint. Unbelievably high numbers. If I would end up selling my home and if I would even get a $10,000 gain, I would be ecstatic. Let alone $250,000. That's just kind of out of my mind. How that could, the people that can enjoy that. If you sell your home for a loss, you don't get to record it though. Hopefully you don't get to sell it for a loss unless you trashed it or you didn't take care of it. So you only report the sale of your home if your gain went over and beyond the $250,000 if you're single, $500,000 for joint filers. Otherwise, you don't even put it on your tax return at all. If you sold it before 2 years and you had one of these items as the reason why you sold it, and it wasn't just to flip a house and make some money, you actually had a good reason why to sell your home, then you can prorate this $250,000 or $500,000 depending on how long you lived there over that full 2-year period. So if you only live there 1 year, you get to take half. You can exclude up to $125,000 or $250,000 for joint. If you live there 18 months instead of 2 years, you get to take 3/4 off. So a nice big savings there for people with higher valued homes for sure. Married filing joint, both people had to live there for 2 years, one of the rules. So in my example here of H, you sell your house for $200,000, bought it in 1950 for $40,000. Well, you have a realized gain of $160,000. However, recognize what goes on the tax return is $0. So $160,000 realized, recognized, nothing. You don't put it on your tax form at all. Same example, except you moved after 6 months, so it's kind of unrealistic. You wouldn't really buy a house for $40,000 and then 6 months later sell it for $200,000, most likely. But we'll just go with it. If that was the case, well, and if we were single, 6 months, that's only 6 out of 24. Let's go back up to my rules here. Here. 6 months out of 24, that's a fourth a fourth of 250,000 is, I believe, 62.5. Yeah. So you would be able to exclude up to 62,500 off of your gain. So instead of having, you would have a realized gain of 160, recognized gain of 97. So I'll put that here. 160 is the realized, 97 is the recognized gain. Okay, last section. So this whole section before, we talked about capital assets. Those were personal use assets and items for investment like stock. The last section has to do with business assets. Anything in the business, remember those are called personal property, which is different than personal use property. Personal property in the business is called Section 1231 assets. And this is any asset in the business, doesn't matter if it's an actual like equipment or if it's a building, as long as you've had it for at least a year. If you've had it for less than a year, then it's treated like a capital asset. The biggest difference between a capital asset and a Section 1231 is how you get to treat losses. The gain treatment is still the same. Losses, you get to deduct any loss. If you sold something out of your business, you get to deduct that off of your business income and not subject to just $3,000. So if you had business income of $100,000, but you had a loss of, you sold some equipment, you had a loss of 10, you could take all 10,000 off of your business income instead of just 3. That's the big difference between Section 1231 and capital assets. Okay, is Section 1231 gain? So if you have a gain, it's treated just like a capital gain. You get the lower bracket on that gain. However, if there is a gain and it's due because you did depreciation, then it's like you didn't really have a gain. You have to add back whatever you took as depreciation before you get to use any Section 1231 special gain treatment. You have to, the amount of gain up to your purchase price, your original basis, is all regular income, taxed at regular income rates. And I'll give an example here, actually a couple. So here's my example here, a car worth $10,000. And you depreciate it at Section 179, day 1. So you saved $10,000 off of taxes in that first year. Your income went down by $10,000. And so therefore you didn't have to pay tax on that $10,000 at 33%. So you saved 33%. Next year you sold the car for $7,000. So it's worth $0 on your books. And you sold it for $7,000, so there's a $7,000 gain. Now, it would be cheating the system, essentially, if you were to take $7,000 at only the capital gain rate, or in this case, the Section 1231 rate, at 15%. Because you got to deduct the depreciation at your normal rate, you save 33%, but you're only going to add back that $7,000 gain of 15,000 or 15%. That would be something like cheating the system. So the tax rules came up with this depreciation recapture. If you are depreciating something, and this is only for regular equipment type items, it's called Section 1245. The gain is treated as ordinary income up to your original basis, or basically the same way, another way of saying how much depreciation you claimed. So in my little example here, this gain of $7,000, that gets me back up to my $10,000 original basis. So all of this gain is taxed at my normal rate of 33%. If it's considered a Section 1250 property, 1245 is for business equipment type items. 1250 is for buildings. So that's the only real, that's the differentiation between the two. So if it's a Section 1250, meaning it was building type property, you tax your gain just like ordinary income, but you get to stop at 25%. So back up to if this was, instead of a car, was a building, and I had $7,000, but that was all because of depreciation purposes. That $7,000, yeah, I don't get to tax it at the awesome rate of 15%, but I also don't have to go all the way up to 33%. This law says you can stop at 25%. So here's my takeaway notes here. To find the recapture, how much you actually have to tax at the regular rate, or if it's a building, up to 25%, you take the lower of gain or your depreciation total. The rest of it would be considered a Section 1231 gain, and you get to tax it at the low rates. So I have 3 more examples, and then we'll be finished. We sold a machine for $2,000. We bought it 4 years ago for our business, so it's a Section 1231 asset because I had it for longer than a year, and it's in my business. I bought it for $1,000. I've taken $600 depreciation, so book value of $400 right now. Our company's in the 15% bracket. Net income of $28,500. All right, so let's answer this first question. What is the book value at the time of the sale? All right, I just mentioned that. Book value is $400. What I bought it for minus how much I've depreciated. Gain or loss? Well, if it's worth $400 on my books and I sold it for $2,000, I have $1,600 realized gain. Now, that's realized. So I don't know how I'm going to treat it yet, but I know that I have $1,600 in actual gain. And then, so now how much of that gain, how much of the $1,600 will be taxed at my normal rate of 15%? And then we go up here to depreciation recapture. Take the lower of the gain, $1,600, or depreciation total, $600. Well, of course, the lower is the depreciation total. So $600 of the gain is taxed at 15%. The remaining $1,000 of the gain is taxed at 0. And then here's the $600 is taxed at your regular rates. $1,000 is taxed at 0. Okay. We sell personal property. Again, this would be like equipment for the business. We bought it 4 years ago, so therefore it's a Section 1231 asset. Bought it for $4,000. We've depreciated it $3,000. Taxable income $75,000. How is this income taxed? What is the book value? Bought it for $4,000. Took $3,000 in depreciation, so book value of $1,000. I sold it for $3,000, so I have a $2,000 gain. How much of the depreciation is recapture? Take the lower of the gain, which was $2,000. I've depreciated, it told me $3,000. So all of the gain is depreciation, recapture, and taxed at the regular rate. And my last example, I purchased a vehicle in 2013 for $20,000. Didn't really need it, so I sold it in less than a year for $22,000 in 2014. Well, this would be not a Section 1231 asset. It would be a regular capital asset, and I had it for less than a year. So therefore, that $2,000 gain is taxed at my normal rate, whatever that would have been. Okay, send me your homework for review, or send your instructor, if it's Cynthia Waddell, Dr. Waddell, send it to her. And any of your tax returns, I'll be glad to take a look. I will be out of the office Thursday and Friday, so I won't get back to you till at least Saturday. Just to let you know that. Okay, I believe that is all for today. So we will stop the lecture and see you next week.